Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. We are thrilled to have you here for this custom deep dive. Today, we're cracking open a really fascinating piece of market intelligence. It's a detailed report from October 15th, 2025.
Yeah, thanks for having me. And that report, it really captures a moment, doesn't it? It was a day that felt like a perfect snapshot of the whole investment landscape right now. Yeah, this incredible news. On one hand, I mean, corporate earnings strength we haven't seen in quite a while.
Yeah.
But, all that optimism was just constantly bumping up against these persistent worries, always under threat.
Okay, let's unpack this then. Our mission today really is to distill the key takeaways from this report. We want to understand that central conflict, that real tug of war that defined the trading session on the 15th. You had these impressive corporate profits hitting head-on against these, paralyzing macro anxieties. It just keeps coming up.
Exactly. It wasn't a market that was confidently marching forward. Not at all. It felt more like a market fighting itself, making these very specific, very high-stakes bets in certain pockets while staying nervous overall.
The report uses a great phrase, calls the session bifurcated and volatile. I think that nails it.
It really does. We saw this aggressive, bullish open, almost entirely driven by those stellar Q3 earnings, especially from the big banks. They were really strong. But then, almost systematically, that early enthusiasm just got tempered down by midday. The focus shifted back to those global trade disputes and, of course, the ongoing drama with the U.S. government shutdown.
Right. So the ultimate takeaway, the vibe check, if you will, from the market is, a lack of clear conviction. That seems to be the main theme.
Completely. Highly reactive. It jumps on every little piece of news, positive or negative.
But it just can't seem to establish a sustained, broad-based rally, can it?
No. It's definitely a market on edge. It celebrates the individual wins, like a great earnings report from one company, but it's constantly looking over its shoulder for the next macro shock.
Okay, so let's dig into the daily dynamics.
Yeah.
Because when you first look at the final numbers for October 15th, they almost look boring, right?
Yeah.
Deceptively quiet.
They really do.
Yeah.
But those numbers, they hide so much chaos that was actually happening under the surface on the trading floor. Let's start with the Dow Jones Industrial Average, the DJIA. That often gives us a good sense of the volatility.
Yeah, the headline number says the Dow finished pretty much flat, closed at 46,253, down just 18 points. That's minus 0.04%. You glance at the ticker, you think nothing happened.
Exactly. A nothing day, you might think.
But here's where it gets really interesting. Like you said, that tiny little change at the close, it completely hides this massive, turbulent intraday swing. That swing tells the real story.
Oh, absolutely. We're talking about the Dow, the blue chip index, trading in a huge range, over 660 points during that single session.
660 points.
Yeah. It soared up to a high of 46,693. That was likely in the morning, propelled by all that optimism around the bank earnings,
Right.
Especially Morgan Stanley's numbers were fantastic. But then it plunged. It fell sharply to a low of 46,027 before managing to claw back some ground later in the day.
Wow. A 660-point whipsaw like that, that's not just random noise. That really speaks volumes about the anxiety and the makeup of this market right now. What do you think drove that huge sell-off after hitting the high?
It was almost certainly the macro fears reasserting themselves. Picture this. Big institutional players start the day feeling good. They're piling into financials, maybe some tech. Based on those strong earnings beats, they push the Dow higher. Then maybe mid-morning or early afternoon, some negative headline crosses the wire, maybe confirmation of those new Chinese export restrictions we'll talk about, or perhaps just more political deadlock news on the government shutdown.
Right, something to spook them.
Exactly. And that initial high conviction money, it pivots instantly. Risk off. You see large-scale selling hit the market, and that drives the index down hundreds of points in, maybe just a couple of hours. So that final nearly flat close, it's just the point where those two massive forces, the earnings optimism and the geopolitical panic, kind of fought each other to a standstill.
So the flatness isn't calm, it's actually profound indecision, a stalemate.
Precisely.
Okay, looking beyond the Dow then.
Yeah.
The S&P 500, the SPX, it actually managed a modest gain, up 0.4% to close at 6,671. But you're saying this wasn't a broad rally either.
No, not at all. It was highly concentrated. The S&P was basically lifted by that pronounced strengths in very specific sectors, primarily financials and technology, the ones that delivered those really knockout earnings reports. They were just powerful enough on the day to offset weakness elsewhere, maybe in more consumer-focused or cyclical areas that are more sensitive to the macro picture. So yeah, a very selective advance.
And the NASDAQ Composite, the CCOMP, that was the leader among the large caps, wasn't it? It closed up 0.7% at 22,670.
It was. And that outperformance, it's a direct signal, really. It confirms that the dominant investment story out there, the narrative that people are still willing to pay a premium for, is that continued bullish sentiment around semiconductors, the supply chain, and especially that artificial intelligence investment cycle.
So the money is still chasing those specific growth stories.
It really is. The market seems to be pouring capital into a pretty narrow set of what it sees as proven growth areas, almost ignoring the broader uncertainty.
Okay, so that intense focus on growth and maybe the hunt for assets that could benefit from potential changes in monetary policy, that leads us right to the day's standout performer, doesn't it? The Russell 2000.
It does indeed. The RUT, the index of small cap stocks, was the day's biggest winner by a decent margin. It surged, 0.96% to finish at 2,532.90. And crucially, during the trading session, it actually hit a fresh all-time high.
That's a really critical data point, isn't it? Hitting an all-time high. Why is the Russell 2000's performance, especially reaching that peak, considered such a powerful market signal? It's more than just small stocks did well today, right?
Oh, absolutely. What's fascinating here and what market pros watch closely is that the RUT is widely seen as maybe the most sensitive barometer we have for monetary policy expectations. See, small cap companies, they're structurally quite different from giants like, say, Apple or Microsoft. They tend to rely much more heavily on bank lending. They usually don't have those huge cash reserves.
Right, more debt dependent.
Exactly. Often higher levels of variable rate debt, too. So when borrowing costs go up or down, these smaller companies feel the pinch, or the benefit, first and often hardest. They're the first to suffer when rates are high, and logically, the first to really celebrate when rates are expected to fall.
Okay, so the Russell surging like that, hitting a new high, it wasn't just random optimism. It was a specific, almost amplified bet by the market, fueled by signals traders perceived as, well, dovish from the Federal Reserve.
Precisely. The market is reading recent Fed commentary, maybe some speeches, some meeting minutes, and interpreting them as signaling potential future rate cuts down the line. And maybe even more importantly for liquidity right now, there's talk about the end of quantitative tightening, or QT.
Okay, let's pause on QT for a second, because most people kind of get rate cuts, but QT often feels a bit like abstract financial jargon. Can you unpack how ending QT specifically helps small caps?
Sure. So quantitative tightening, QT, it's basically the Fed running quantitative easing, QE, in reverse. Instead of injecting liquidity by buying bonds, the Fed pulls liquidity out of the financial system. It does this by letting the bonds it owns mature and just run off its balance sheet without reinvesting the principal payment it gets back. Yeah. This process actively reduces the overall supply of money in the system, and that tends to push borrowing costs up across the board. It makes capital scarcer and more expensive for everyone, but especially for those smaller firms.
Right, it tightens financial conditions.
Exactly. So when the Fed signals it might stop or end QT, it means they're going to stop actively shrinking the money supply. That stabilization, or maybe even an eventual slight expansion of liquidity later on, makes capital more accessible again, and potentially cheaper. And that's a huge relief for smaller firms that desperately need that capital to grow, to invest, to service their existing debt. So the Russell hitting an all-time high, you can read that as the market saying, okay, the capital drought is ending, and these more debt-reliant companies are going to benefit disproportionately.
That makes a lot of sense. It's a direct signal about liquidity conditions improving, or at least stabilizing. But I have to ask, the skeptic in me wonders, are we sure this isn't just the market wishing for lower rates, getting ahead of itself rather than responding to concrete policy shifts?
That is the absolute critical risk hanging over that RUT optimism. You've hit the nail on the head.
Especially with key economic data like inflation reports being delayed by this government shutdown. Does the Fed really have enough real-time info to actually justify cutting rates if inflation proves sticky?
That's the million-dollar question, isn't it? The market is definitely pricing in the outcome it wants. It's betting that either the economy will slow down enough soon to force the Fed's hand, or maybe that the Fed will prioritize supporting financial stability over chasing down that last little bit of inflation overshoot. It's a gamble. If the Fed comes out next month and disappoints those expectations, if they signal higher for longer on rates, then the Russell 2000 could very well be the first index to give back a chunk of these recent gains. It's definitely a high conviction bet, but also carries significant risk right now.
Okay, so while the Russell was betting on the future, the Q3 earnings reports were providing the hard facts, the concrete evidence driving strength today, especially in financials. Bank of America, BAC, climbed almost 4%, right? 3.9%.
Yep. BAC was up 3.9% after beating estimates. They reported $1.06 in earnings per share when the consensus was looking for around 94 cents. So a solid beat.
What drove that beat?
It seemed pretty broad-based within the bank. The report mentioned strength from robust trading revenue, which suggests institutional clients are still active, and also healthy net interest income, or NII. NII is basically the bread and butter for banks, the difference between what they earn on loans and what they pay out on deposits. So BAC's results gave some confidence that the core banking engine is still running pretty well, despite all the macro fears swirling around.
Okay, solid. But the real showstopper in banking on the 15th seems to have been Morgan Stanley, MS.
Yeah.
Their stock surged, what was it, almost 7%.
A massive 6.9% jump for Morgan Stanley. And this wasn't just squeaking by estimates. This was a truly exceptional beat. They posted an astonishing $2.80 in earnings per share. The street was only anticipating around $2.08.
Wow, that's huge.
The positive surprise of nearly 35% just blew expectations out of the water. And the key insight here wasn't just the size of the beat, but where that strength came from. The report highlighted resilience in their wealth management division and also their trading operations.
So what does that tell us?
It suggests that high net worth individuals, their clients in wealth management, and also large corporations using their trading services are still very active. They're still engaging heavily in capital markets using advisory services. It kind of signals that the top tier of the economy, at least, seems extremely resilient to the inflation and recession fears that are maybe hitting other parts more directly.
Interesting. Okay, and circling back to why the NASDAQ was leading the technology pillar, that still seems strongly supported by this ongoing AI momentum narrative. And we got key news from ASML, the Dutch semiconductor equipment giant.
Yes, ASML Holding. They are absolutely critical. You could call them the vital choke point in the entire advanced semiconductor ecosystem. They're basically the only company in the world that makes the sophisticated extreme ultraviolet lithography, or EUV, machines.
So machines needed to make the most advanced chips for AI, smartphones, everything.
Exactly. So their guidance, what they say about future demand, is treated almost like gospel by the market for the whole tech sector. And their forecast was bullish, very bullish. They came out saying they expect their 2025 revenue to be about 15% higher than the previous years. That's a massive number for a company of their scale.
Yeah.
And it's seen as huge validation that this AI investment cycle isn't just hype, it's accelerating.
Did they specifically mention AI?
They did. The report quotes their CEO citing continued positive momentum around investments in AI as the core driver for that upbeat forecast.
Okay, and that news immediately lifted other players in the space, right? NVIDIA, Broadcom.
Instantly. NVIDIA and VDA rose 1.2% on the day. Broadcom EVGO gained a strong 3%. The market basically takes ASML's guidance as concrete proof that companies like NVIDIA and Broadcom, who design the chips that rely on ASML's machines, are going to see continued strong demand. It validates the whole food chain.
And there was even more specific news reinforcing that AI demand, wasn't there? Something about NVIDIA chips and Microsoft?
Yes, exactly. There was also news confirming that NVIDIA's very advanced GB300 chips are being deployed right now for a massive new Microsoft data center site down in Texas. This kind of news is important because it moves the AI story from just, theoretical future demand to concrete, large-scale implementation happening today. It provides this layer of company-specific validation, showing the investments in data center infrastructure are immediate and substantial.
So that combination of the big picture from ASML and the specific deployments for NVIDIA, that explains why tech remains the clear leader. It has both those compelling long-term structural tailwinds and the hard data earnings support right now.
That's exactly right. It's a powerful combination in this kind of uncertain market.
Okay. But now we absolutely have to pivot. We have to look at the other side of that massive 660-point Dow swing. We need to talk about the powerful counterweights, the anchors that were responsible for creating that huge intraday volatility and ultimately capping the day's gains.
Yeah, these persistent macroeconomic and geopolitical concerns. They're the market's constant burden right now. They prove that even really strong earnings, like we saw from the banks, just aren't enough on their own to drive sustained, broad optimism.
And topping that list of worries, the report specifically calls it the most significant source of investor anxiety. It's the ongoing U.S.-China geopolitical friction.
It really hangs over everything. And we're not just talking vague tensions anymore. We're seeing concrete escalating flashpoints that are moving beyond just tariffs and hitting critical supply chains directly.
Like China's new export restrictions on rare earth minerals.
Exactly. That's a very sophisticated, targeted move. It hits the U.S. industrial base right where it hurts. Rare earth minerals. Things like neodymium, which is crucial for high-powered magnets used in defense systems, electric vehicle motors,
Right.
or dysprosium, which is vital for lasers and specialized electronics.
Stuff we absolutely need for modern tech and defense.
Absolutely fundamental components. And China controls a huge percentage of the global supply and, maybe more importantly, the processing capacity for these minerals. So imposing export restrictions creates immediate uncertainty for global supply chains. It specifically impacts key U.S. sectors like aerospace, specialized defense contractors, and also EV manufacturing that happens outside of China.
So it's not just a trade tiff, it's using a real economic choke point.
It's an active geopolitical lever being pulled. And then you have renewed threats from President Trump about potential additional tariffs, maybe even something specific like a cooking oil embargo. It all just adds to the noise and the anxiety.
Okay, so that's the international friction. Meanwhile, back home, adding another massive layer of uncertainty is the U.S. government shutdown, which was 15 days old on October 15th. And that created what the report calls a severe data vacuum.
Yes, and this raises an extremely important practical problem for investors and policymakers right now. Everyone is struggling with this question. How can the Federal Reserve, or really any major financial institution trying to make informed decisions, accurately gauge the true health of the economy?
When crucial data isn't coming out.
Exactly. When the big reports, the Comprehensive Consumer Price Index, CPI, telling us about inflation, the official employment reports, key manufacturing surveys, when they're all postponed indefinitely, it means the Fed is essentially forced to fly blind.
Relying on what? Anecdotes? Private surveys?
Pretty much.
Yeah.
They have to rely on anecdotal evidence, less comprehensive regional Fed surveys, or maybe some private sector data proxies that just aren't as reliable or timely as the official government numbers. And that lack of foundational data significantly increases the risk of making a monetary policy error. That's a major fear factor contributing to those market jitters we talked about.
That fear factor, we can actually quantify it, right? Using the SIBO Volatility Index, the VIX, our so-called fear gauge. And here on October 15th, we saw a really interesting paradox.
A major paradox. Because even though the S&P 500 and the NASDAQ managed to close higher on the day, the VIX remained stubbornly elevated.
It closed at 19.51. Now, that was down about 6.25% for the day, but 19.51 is still high, isn't it?
It is definitely elevated. To put that in context for listeners, VIX readings below, say, 15 typically signal a pretty calm, confident, maybe even complacent market environment. A reading up near 20, like we saw, isn't signaling outright panic that usually kicks in maybe around 30 or higher, but it absolutely signals persistent, expensive anxiety. It's like a low-grade fever that just won't break.
What does it mean in practical terms?
It means there's relentless demand for portfolio protection. Investors are buying options, particularly put options, as insurance against a potential market downturn. So you have this weird situation where market participants are selectively buying certain assets like those bank stocks or the AI plays we discussed, but at the same time, they're hedging heavily against a broader macro shock. They're not structurally committed to a full risk-on posture.
That caution, that search for safety, it's also dramatically visible in the commodities market, isn't it? Particularly the absolutely staggering rise in gold.
Staggering is the right word. Gold rallied another 1.1% on October 15th, and it broke through to a new record high, above $4,200 an ounce.
$4,200 an ounce, that's historic.
It is. And the fact that gold is now up nearly 60% just year to date, that's a direct consequence, a direct reflection of deep investor distrust in global political stability and economic certainty.
What's driving that sustained rally, do you think?
It's several things converging. It's the geopolitical risk we just detailed, the U.S.-China friction, other global hotspots. It's also the long-term fear about the debasement of fiat currencies, paper money, because governments around the world just keep issuing enormous amounts of debt. And you probably also have high-stakes election cycles happening globally, adding to the uncertainty. So investors are systematically moving away from paper assets and currencies they see as unstable, and they're fleeing into the ultimate traditional safe haven asset. Gold's price isn't just reacting to daily news headlines anymore. It feels like it's reacting to deeper systemic unease.
Okay, now contrast that flight to safety in gold with what happened to crude oil on the same day. West Texas Intermediate WTI crude, it was trading near $58.40 a barrel, and it was under pressure.
Yeah, oil is caught in a different crosscurrent. It's responding more to the other side of that trade friction coin, worries about global economic growth. Oil traders are trying to balance potential production cuts from OPEC Plus against two major fears. First, there was a warning out from the International Energy Agency, the IEA, about a potential supply glut coming in 2026, mainly due to increased production from countries outside of OPEC. That caps the upside. And second, more immediately, there are those persistent fears that the ongoing U.S.-China trade tensions, if they escalate, could seriously dampen overall global economic demand. Less demand means less industrial activity, less travel, and ultimately lower forecasts for energy consumption.
So gold up on systemic fear, oil down on growth fears. Makes sense. And finally, just quickly, in the crypto space, Bitcoin showed weakness.
It did. Bitcoin was down about 2% on the day, trading near $110,783. It clearly wasn't attracting that same kind of institutional safe haven bid that gold was seeing.
Why do you think that is?
Well, it really highlights a key difference. In moments of, really acute geopolitical tension or systemic risk, the big institutional players, the large-scale asset managers, they still seem to favor assets with literally centuries of history and proven reliability as a store of value. While cryptocurrencies like Bitcoin certainly offer features like decentralization and security, they just haven't fully earned that institutional stamp of approval yet as a primary hedge against systemic meltdown. Gold's performance relative to Bitcoin on a day like this really underscores how major capital still views risk versus reward when deep uncertainty takes hold.
Okay, let's shift back now to the company level, but maybe with a more nuanced perspective.
Yeah.
The report makes a really interesting point, saying the market is demonstrating a sophisticated and forward-looking approach.
Yeah, I like that phrasing.
In plain English, what does that mean? It sounds like the market is just being ruthless, doesn't it? It cares way more about future growth prospects, the guidance a company gives, than it does about past performance, like beating last quarter's earnings.
That's exactly what it means. And it's a crucial strategic shift investors need to understand right now. The days when a company could get a nice stock bump just because they beat the EPS estimate for the quarter that just ended, those days seem to be over, at least for now. Historical results, what happened last quarter, they only seem to matter if the company can credibly signal that the immediate future also looks bright and predictable. The market isn't looking in the rear-view mirror anymore. It's staring intently through the windscreen. And if that forward guidance looks cloudy or cautious, bam, they hit the brakes instantly. No hesitation.
And the PNC Financial example from October 15th is the perfect illustration of this ruthlessness, right? PNC stock fell 3.9%, despite beating profit estimates. That seems totally counterintuitive at first glance.
It does, unless you apply that guidance lens. PNC was punished purely because its forward earnings forecast, the guidance it gave for future quarters, was cautious. Management must have signaled some headwinds coming, maybe related to rising credit costs as the economy slows, or perhaps the ongoing challenges of the interest rate environment for regional banks. Whatever the specifics, the market looked straight past the solid Q3 numbers they just reported and punished the stock simply for signaling potential weakness 6 or 12 months down the road.
Wow. And it seems like there's zero tolerance right now for even minor operational slip-ups. Look at Abbott Laboratories, ABT. Their shares dropped 2.8% just because they narrowly missed revenue expectations.
Yeah, even a narrow miss on the top line was enough to send the stock down significantly. The signal from the market here is crystal clear. Investors are demanding near perfection if they're going to justify paying the current multiples for stocks in this volatile environment. A slight revenue miss, a slightly cautious outlook on margins, it gives fund managers an immediate justification to say, okay, let's reduce exposure here, take some profits, and maybe move that capital to the next opportunity that looks a bit safer or has clearer momentum. There's just very little patience right now.
That demanding attitude, that scrutiny, it definitely continued into the after-hours trading session on the 15th. That session often gives us a clearer look at high-conviction reactions to specific company news, sometimes separate from the big macro tides.
Absolutely. After hours can be very telling.
Okay, let's do a quick deep dive on some of the notable movers. The top loser after the bell was Corpay Inc., CPAY. It plummeted 10.25% down to $260.10. What was the story there?
The catalyst was an announcement. Corpay announced they were making a pretty significant acquisition, spending $550 million to buy a 34% stake in another company called Avid Exchange. Now, management tried to spin this positively, claiming the transaction would be slightly accretive to earnings, meaning it should add a little bit to profits.
But the market clearly didn't buy it. A 10% drop is an overwhelming thumbs down.
Absolutely. It signals intense investor concern on several potential fronts. First, maybe they worry about the deal valuation. Did Corpay pay too much for that stake? That's always a concern in M&A. Second, integration risks are always huge when companies combine or take large stakes. Merging corporate cultures, aligning strategies, dealing with systems. It's notoriously difficult and can distract management.
But maybe most importantly,
Perhaps most significantly, that sharp negative reaction suggests investors perceive this move as a dilution of Corpay's core focus. People likely own CPA stock for specific exposure to its existing corporate payments business. Taking a major stake in Avid Exchange, which might be seen as a somewhat different business, introduces complexity and maybe risks that those original investors didn't sign up for. That often leads to capital flight.
okay, so Beal concerns, integration, loss of focus, got it. Another notable loser after hours was United Rentals, URI. It fell 4.53%. They actually report earnings next week on October 22nd.
Right. So this looks like a classic case of pre-earnings anxiety, probably layered on top of some of those macro fears we discussed. United Rentals is the world's biggest equipment rental company.
Meaning their business is highly tied to construction infrastructure.
Exactly. Their revenue is extremely sensitive to the health of the industrial sector, infrastructure spending, and overall construction activity. So that negative move in the stock before the earnings report suggests investors might be preemptively pricing in some caution. They might be worried that those macro headwinds, maybe delays in infrastructure projects due to the government shutdown, for example, could negatively impact equipment rental demand when URI reports its official numbers. It's nervousness ahead of the actual data.
Makes sense. But it wasn't all negative after hours. There were winners, too. Host Hotels and Resorts, HST, was actually a top gainer, rising almost 4%, 3.97% to $17.03. What drove that?
This seemed to be driven by a positive reevaluation of the company's fundamentals. The report linked the positive sentiment to some strong analyst commentary pointing to expected growth in a key hotel metric called revenue per available room. The forecasts mentioned were for solid growth of 1.5% to 2.5% in 2025. And crucially, especially in this kind of uncertain market environment, the market seemed to be rewarding host hotels for its robust financial position. The report specifically noted their healthy liquidity buffer of $2.3 billion.
So a strong balance sheet and visible forward momentum are getting rewarded.
Clearly, in a volatile world, quality balance sheets and some degree of predictable growth are highly valued premiums.
Okay, and finally, let's turn to the post-close spotlight, which was on United Airlines UAL. They reported their earnings right after the closing bell on the 15th.
Yes. And heading into that UAL report, expectations were really cautious across the board. The consensus analyst estimate for earnings per share was only $2.64. Now that might sound okay, but it represented a forecast for a significant year-over-year decline of over 20%. So analysts were bracing for a tough quarter.
Why the pessimism?
It reflected worries about persistent margin pressures, things like still high fuel costs, ongoing labor negotiations, potentially leading to higher wages. The market was basically braced for bad news from United.
Okay, but then what happened in initial after-hours trading? The stock actually went up.
It did. Initial trading saw UEL shares up about 2.63%. This looks like a classic case study in beating lowered expectations.
Meaning the results weren't as bad as feared.
It strongly suggests that either the actual Q3 results came in better than that very low $2.64 bar, or perhaps more critically for the stock reaction, the forward guidance the company gave, maybe regarding future capacity plans, pricing power, or cost controls, was less dire than the deeply cautious market had previously feared.
So what happens next with UAL?
Well, traders and analysts will spend the next day digging through the details of the report and, importantly, the management commentary from the earnings call. They'll be looking for clues to set the tone, not just for United, but for the broader airline and transport sector. Any signs that those margin pressures are finally stabilizing, or that travel demand has remained surprisingly robust despite the wider economic jitters? That would be seen as quite positive.
Okay, so looking ahead from October 15th, the immediate future, based on the futures market, suggests, well, continued low conviction, doesn't it? U.S. stock futures were pointing to a very tentative open for the next day, with Dow futures up only a tiny 0.01%.
Yeah, that screams indecision. Traders are clearly sitting on their hands waiting for fresh, actionable catalysts. They need something concrete to help them decide which side of that tug-of-war we keep talking about, the earnings strength or the macro fear, is actually going to win out in the near term.
And given that massive data vacuum we discussed, caused by the government shutdown, where does the market's focus have to shift to get those catalysts?
It has to shift almost entirely to the data points we can still get. That means the regional Federal Reserve surveys and various private sector data releases. These become absolutely crucial proxies for the official national reports that we're missing.
Okay, so looking at the calendar right after the 15th, Thursday the 16th, seemed critical. What was the most important release scheduled for that day?
Without a doubt, it was the Philadelphia Fed Manufacturing Index. The consensus forecast among economists was for a reading of 8.6. Now, that would have been a really steep drop from the previous month's reading of 23.2.
Why is that particular regional index so important, especially now?
Because it provides one of the earliest, most granular gauges of manufacturing health in a really key industrial region of the country. It gives insights into things like new orders, shipments, employment within manufacturing, and maybe most importantly right now, price pressures within the sector. Since we're missing the official national CPI data, this regional index becomes a major proxy for inflation sentiment as well as industrial health. A really weak Philly Fed reading would likely intensify recession fears. On the other hand, a surprise upside print showing unexpected strength or price pressures might actually challenge those dovish Fed bets that the Russell 2000 rally seems to be relying on. So a lot was riding on that number.
Okay. And meanwhile, beyond the daily data points, the heart of the Q3 earnings season was just starting to accelerate dramatically right after the 15th. That's the real fundamental test of underlying corporate strength, isn't it?
It absolutely is. The pace of reporting was set to pick up significantly in the following week or so.
And if we connect this back to the bigger picture, the global picture, what was the single most important near-term earnings catalyst that everyone was watching for that week?
Globally, it had to be Taiwan Semiconductor Manufacturing Company, TSM. They were scheduled to report on Thursday, October 16th. TSM isn't just another tech company, it's arguably the hinge upon which the entire global technology economy turns.
Because they manufacture chips for basically everyone: Apple, Nvidia, AMD.
Exactly. As the world's undisputed leading contract chip manufacturer, or foundry, what TSM says about current demand trends, future orders, and especially their plans for capital expenditures. That commentary sets the tone for the entire global technology supply chain.
So if ASML, the equipment maker, gave us optimism by saying they're selling the machines, TSM's report is the one that confirms whether that demand is actually translating into booked orders and real production on the manufacturing front.
Precisely. That's the perfect way to put it. Everyone would have been scrutinizing TSM's guidance, especially looking for any signs of a slowdown in their capital expenditure plans, their CapEx. If TSM signaled they were still planning to ramp up CapEx significantly, it would powerfully validate this multi-year AI investment boom narrative.
Yeah.
But if they signaled any caution, maybe delayed some spending, that could potentially deflate the entire tech sector rally and rapidly erode those recent gains we saw in the NASDAQ. That TSM report was an absolute must-watch for anyone invested in the AI momentum trade.
Okay, so TSM on Thursday, and then beyond that, the following week, October 21st to 24th, looked like a true deluge of mega-cap earnings reports. A real test for all the market things we've been discussing.
Log a gauntlet, really. Yes, absolutely. Starting October 21st, we had Netflix, NFLX. The focus there would be intensely on subscriber growth numbers naturally, but also critically on the performance, and, importantly, the monetization of their newer ad-supported subscription tier. Is it bringing in new users? Is it profitable? Then, the very next day, October 22nd, Tesla, TSLA, always a market mover. The report would reveal crucial updates on global demand for electric vehicles. Is it holding up? Also, the state of their relentless margin pressures, which have been a big concern, and of course, any updates on the production ramp-up for the Cybertruck. That report really sets the tone for the whole EV and auto sector.
Okay, then Intel INTC reports on the 23rd. What's the focus there?
For Intel, it's really two key things. First, progress on its ambitious foundry business strategy. That's their attempt to catch up with rivals like TSM and manufacture chips for other companies. Is it gaining traction? Second, what are they seeing in terms of the overall health of the traditional PC market recovery? Is that rebound sustainable? And then finally, rounding out that packed week on October 24th, we get a really crucial window into the average consumer's behavior with Procter & Gamble, PG.
Right, the consumer staples giant.
Exactly. Their report provides granular insight into consumer spending habits.
Are shoppers still buying premium brands, or are they trading down to cheaper private labels because of inflation? And crucially, is P&G still able to maintain its pricing power? Can they pass on higher costs in what's still a pretty inflationary environment?
Wow. So those reports, collectively, over just a few days, they would either provide strong validation for the market's current selective rally, or they could potentially expose some serious underlying vulnerabilities.
That's exactly right. A huge test.
So let's try to synthesize all of this then. Looking back at that detailed report from October 15th, it feels like the market was, and likely still is, existing in what we can probably best describe as a precarious equilibrium. Is that fair?
I think that's a very good way to put it. Precarious equilibrium. You've got corporate fundamentals, especially driven by those stellar earnings we saw from financials and tech, providing undeniable support underneath. There's real strength there.
Yeah.
But that strength is constantly fighting against the crushing weight of these systemic macro risks. The geopolitics, the policy uncertainty, the inflation worries. And that's why you saw that huge 660-point intraday volatility on the Dow. The two forces are incredibly powerful and currently quite balanced.
Which means the path of least resistance for the market. It's not yet clearly and sustainably upward, is it?
Not by a long shot. The overall market narrative remains intensely unresolved. It's full of contradictions.
So for you, the investor, trying to navigate this environment, it's essential to monitor these key signposts really closely in the coming days and weeks. What are the absolute must-watch items?
Okay, number one has to be corporate guidance. As we saw with PNC and Abbott Labs, the market is completely unforgiving of caution right now. Future outlook trumps past results. Number two, specifically for tech investors, is TSM's view on the global tech ecosystem. Their commentary, especially on CapEx, will likely dictate the Nasdaq's direction. Number three, you absolutely have to keep an eye on U.S.-China geopolitical headlines. They remain an overwhelming systemic risk factor that can change the market mood instantly. And finally, number four, watch for any deviation from the current dovish consensus being priced in from the Fed. If policymakers push back harder against rate cut expectations, that could quickly erase those recent gains we saw in interest rate-sensitive areas like the Russell 2000.
It really is a fascinating, almost schizophrenic split reality we're navigating, isn't it? You have the resilience of the Russell 2000 hitting all-time highs, suggesting investors have profound faith in lower rates coming, and maybe strong domestic economic growth.
Right, betting on a soft landing or policy easing.
Yet, at the exact same time, you have the soaring historic price of gold blowing past $4,200 an ounce, which signals profound distrust in global political stability and long-term economic certainty.
Total opposites, existing side by side.
So, what does this all mean for you trying to manage your portfolio in this bifurcated environment?
Well, that leads us to the final provocative thought, doesn't it? Given this fundamental tension, strong individual company results happening against a backdrop of intense systemic risk, can that fundamental strength of specific companies ever truly insulate your portfolio from those massive macro shocks? You know, something like a full-blown U.S.-China trade war escalating, or the Fed making a major policy error because of bad data.
Or is the reality that in this environment, this world of simultaneous corporate celebration and deep systemic fear, is selective hedging almost mandatory now? Do you have to build in some protection if you hope to preserve your capital through whatever the next major geopolitical or economic wave turns out to be?
That's the critical question, I think. It's the strategic puzzle every sophisticated investor must be wrestling with as we head deeper into this crucial earnings season and navigate these uncertain waters.
A question that perfectly defines this volatile moment. Thank you so much for walking us through that report today. Really insightful.
My pleasure. Always good to talk markets.
And thank you for joining us for this deep dive. We'll talk to you next time on Bulls, Bears, and the Bell.